Hello and welcome to this Wealth of Advice market update that I'm recording on the Thursday, the 7th of November. Recording it from across here in Orlando, Florida, where I've been on holiday since last Thursday. I know Matthew and Joe have done an excellent video last week about what happened in the UK budget on the Wednesday. So much to digest from that. And again, please be rest assured, everyone at Wealth of Advice is looking at what came out of the budget. We're speaking with various pension investment providers, and we'll be in touch with updates on what we think is the best advice for everyone to do going forward. It will form a main part of our annual client conference that we'll be holding on Friday, the 31st of January at Durham Cricket Club across at Chesley Street. We've put an invite link on this message. Yes, there'll be fund managers there talking about how investment funds are going to hopefully going to perform in 2025. We will be looking at what's happened since 2020. We're 5 years on since COVID. How has that affected markets over the last 5 years? And then, as I said, because there's so much coming out of that budget last week, we're going to cover that as a main part of the day. So please come along. Across here in the US, I'm sure everyone's aware, Donald Trump was re-elected as president on Tuesday. We got here last Thursday, and literally every person we spoke to when we were talking about the election was voting for Donald Trump. Nobody seemed to vote for Kamala Harris, and who we were speaking to, and if you look at the results, it was a pretty much landslide victory that he achieved. Markets have responded well to that. Markets like a Republican in the White House, they do big things for big companies, basically, and markets have shot up lovely. It was interesting. Tesla shares went up massively yesterday because Elon Musk obviously provided a lot of funding for the Donald Trump campaign, and he's now expecting a position within the government. So it'll be interesting to see how that unfolds. No markets have really suffered as a result. There was a lot of panic and fear in the lead up to it. But if you look at the VIX index, the measure of risk, that came down massively once we knew there was a one-sided strong outcome, which is what markets want, really. As I said there, we're recording this on the Thursday evening. Across here in America, where they've reduced their interest rates by 0.25% a day. Bank of England earlier in the day also reduced ours by 0.25%. So banks around the world are looking to cut interest rates to make sure markets don't and economies don't go into recession. So we think that's positive. And overall, markets have been very positive these last couple of days since the election, and we hope that's going to continue.
Today, Joe and myself are going to cover the US election results and interest rate cuts in the UK and the US. As we approached the US election, we were talking to lots of fund managers about the potential impacts, and their view was, regardless of which candidate was elected, it would be positive for the markets. They predicted a very close election, and in reality, this was not the case. Donald Trump was re-elected as the US president, and his win opens the door for tax cuts, deregulation, and tougher trade policy. On trade, Trump has promised a wide range of tariffs, including 60% on Chinese imports and 10 to 20% elsewhere. He will certainly make this a key point of his early term. However, how he implements this will be difficult. Overall, his stance could reinforce geopolitical and economic division and a structural issue which could keep inflation higher for the long term. Interestingly, the initial market reaction to his election, as predicted, was very positive. Trump's win likely means some deregulation, including rolling back banking regulations. It'll be interesting to see how his relationship with Elon Musk also develops, because prior to the election, they'd been more focused on monopolies and how the use of AI was coming under the spotlight a bit more. Republicans will aim to boost energy production. However, the US oil and gas output is already at an all-time high, and it's difficult to ramp up production, and this certainly takes time. We also feel it's going to be key to look at things like inflation and the electronic vehicle agenda, which is likely to be pulled back but not repealed fully. In the near term, we see US equities doing well, supported by solid economic and corporate earnings growth, political clarity, and Federal Reserve rate cuts. Longer term, it'll be very interesting to see how Trump's global agenda comes into force and how that impacts on market performance, both for the US and wider global returns. We think that some sectors such as energy, financial companies, and tech sectors can certainly benefit from that deregulation, but it's going to be interesting to see how other factors such as supply chain constraints, an aging workforce, how that impacts inflation. It's likely that we'll see inflation stay above that pre-pandemic level. As I mentioned earlier, the immediate reaction to the election was very positive for US equities, and we've seen the dollar strengthen. This shows that investors are very happy with clarity over the election, and therefore, strong returns have followed.
Looking towards the UK, the labour market remains tight, with unemployment falling to 4% and pay growth remaining high at 4.9% year on year in August. Despite this, September's CPI, which is inflation, declined significantly to 1.7% year on year, with core inflation sticking at 3.2%. The Bank of England, just yesterday, cut interest rates by 0.25%, bringing the base rate down to 4.75%. Analysts, however, have warned that subsequent rate cuts could be delayed due to the government's budget last week and their tax and spend that was included in it. Analysts at Goldman Sachs predict that stronger growth in 2025 are likely to reduce urgency for additional cuts from the Bank of England in the near term. Back in the US, September's CPI figure indicated that inflation eased by less than expected. Headline CPI rose 2.4% year on year, marking the slowest annual increase since early 2021. However, core inflation remained elevated at 3.3%, driven by rising costs in medical care, auto insurance, and airline fares. Following the Fed's 0.5% interest rate cut in September, sticky core inflation highlights the challenge facing the US Federal Reserve if they are to achieve their dual mandate of maintaining a solid labour market alongside inflation stability. Following on from this, last night, the US Federal Reserve have just cut interest rates by 0.25%, bringing them down to a range of 4.5 to 4.75. The US may also potentially cut rates in December, but a strong labour market and resilient inflation are factors that the central bank will need to navigate before deciding on a rate cut.
What do those interest rate cuts mean for yourself? Martin Lewis has been looking at cash rates this week, and therefore we thought it was also a good time to look at them for yourselves. As you can see on this chart, this shows the top savings rates over the past year. The red bar shows the top 1 year fixes, which have come steadily down. And then the green bar there shows the easy access bank accounts in comparison to the dotted yellow line, which is the base rate. So as you can see, now compared to a year ago, cash rates are a lot lower. And therefore, we're seeing more clients think about investing their cash ISAs into stocks and shares ISAs. If that's something you're interested in doing, please get in touch with us. But it's also important to make sure that any cash that you have got in the bank is earning a good rate for yourself. So an easy access account could be paying around 5%, and it's possible that you could actually fix slightly below that figure at the minute. So again, have a look at what your cash accounts are earning and see if there's any ability to squeeze some extra returns from them, or if you are thinking about holding those funds for the longer term and you're happy to take some investment risk, potentially think about the stocks and shares approach. So as always, we like to look at the market performance, and on this first chart, we've got a year-to-date performance. You'll see that green tick and the red tick there for the S&P 500, the US market, and the world market from the MSCI World. The tick up at the end there is from Trump's election results. So whilst we've had steady performance throughout the year, you can certainly see that they were waiting for that announcement and the political stability. When we look over the 1 year performance, that's very similar to the year to date as we approach the end of the year. We had that wobble in August when markets sold off slightly, but we saw that come back quickly. And actually, it's been a very stable year for investors in equities. When we look over the 5 year picture, we can see, COVID's nearly fallen out of the rear view mirror, but that helps frame investment performance. And as you can see at the bottom, the FTSE 100, the UK indices there has fallen behind the likes of the US and the world markets over the last 5 years. Interestingly, with US currency strengthening, there is a view that overseas earnings revalued for companies on the FTSE 100 may see them improve slightly. So we'll be continuing to sort of review that and focus that when we look at our portfolios for clients. It won't be long till we record our next portfolio update for clients, so that'll be coming out in the next couple of weeks. As always, if you've got any questions about the recent Labour budget, Trump's election, or any of the changes to interest rates, please don't hesitate to get in touch. Thank you.